Have you ever wondered how businesses protect themselves from the risk of non-payment by their customers? It's an intriguing question, right? One solution is trade credit insurance, a unique type of insurance policy designed to shield businesses from this very risk. Think about it. Businesses often sell products or services on credit terms, which means they're extending a line of trust to their customers. But what happens if their customers can't or simply won't pay up? This is where trade credit insurance steps in, serving as a safety net for these businesses' accounts receivable. By taking out a trade credit insurance policy, businesses can manage the risk associated with extending credit to their customers. It's a strategic move that provides essential protection against the unpredictability of the business world. So, now that we've touched on the basics of trade credit insurance, let's delve into the key components and functions of trade credit insurance. Trade credit insurance is more than just a safety net for businesses. It's a multifaceted tool that provides a range of benefits. Let's delve into the key components and functions of trade credit insurance. First and foremost, it offers protection against non-payment. If a customer fails to pay for goods or services due to reasons like insolvency, protracted default, or political events, trade credit insurance steps in to cover the loss. Next, it's a significant player in risk mitigation. By transferring the risk of non-payment to an insurance company, businesses can reduce their exposure to financial losses and confidently expand sales to new customers or markets. What about cash flow? Well, trade credit insurance helps maintain a stable cash flow by ensuring businesses receive payment, even when customers are unable to pay. This is particularly crucial for companies with a significant portion of their working capital tied up in accounts receivable. The security of credit insurance opens up a world of expansion opportunities. Businesses can explore selling on credit terms, both domestically and internationally, without the fear of excessive financial risk. Trade credit insurance can also be customized to suit the specific needs of a business. They can select coverage for certain customers, markets, or products. Moreover, trade credit insurers often provide valuable market intelligence and credit risk assessment services, aiding businesses in making informed decisions. On the financing front, insured accounts receivable can be used as collateral, making it easier for businesses to obtain financing or working capital loans. In the unfortunate event of a customer default, the insured business can file a claim with the insurance company, which then reimburses the agreed-upon percentage of the outstanding debt. There are various types of policies to choose from, allowing businesses to tailor them to cover domestic or international trade, single transactions, or a portfolio of customers. While the cost of trade credit insurance varies, it's important to remember that it may not cover all circumstances, and there may be exclusions or limitations in the policy. Therefore, understanding the policy's terms and conditions is a must. Clearly, trade credit insurance is a complex but essential tool for businesses. But how exactly does it benefit them? Trade credit insurance isn't just about protection, it's about growth and stability. Indeed, the value of trade credit insurance extends far beyond simply safeguarding against non-payment. It is a critical tool that empowers businesses to maintain a stable cash flow. How so, you may ask? Well, by ensuring that businesses receive payment even when customers are unable to meet their obligations, trade credit insurance helps keep the cash flowing. This is of paramount importance, especially for companies with a significant portion of their working capital tied up in accounts receivable. But that's just the beginning. Trade credit insurance also paves the way for businesses to explore new horizons. With the security provided by credit insurance, businesses can confidently venture into new markets, domestically or internationally. They can sell on credit terms without the fear of excessive financial risk. Essentially, it's like having a safety net, allowing businesses to take calculated risks that can lead to growth and expansion. Customization is another key benefit of trade credit insurance. Businesses are not confined to a one-size-fits-all policy. Instead, they can tailor their coverage to their specific needs, choosing to insure certain customers, markets, or products. This flexibility allows businesses to manage their risk effectively and efficiently. Now, let's talk about market intelligence to be precise. Trade credit insurers often provide valuable market intelligence and credit risk assessment services. These insights can guide businesses in making informed decisions about which customers to do business with or which markets to tap into. It's like having an expert advisor on your team, providing you with timely and relevant information to steer your business in the right direction. Finally, trade credit insurance can also facilitate financing. Some lenders may consider insured accounts receivable as collateral, making it easier for businesses to secure financing or working capital loans. Trade credit insurance is indeed a valuable risk management tool that helps businesses protect their financial stability and continue to grow, despite the risks associated with offering credit to customers. It's an investment in peace of mind and future success.